and I'm coming in from the book. Those of you with the book, you can go to IFRS 9. If you don't have the book, you can take a screenshot or write. It's your swag. So we are going to be using this app to illustrate how we can deal with some of the issues relating to financial instruments. So in the middle, we have the entity selling or issuing. Then on the far right, we have the entity buying or purchasing. We have the entity buying or purchasing. So issue of shares. If an entity issues shares, does the entity have an obligation to repay? No. Shares are equity instruments. So in the books of the entity that is issuing the shares, we have to recognize what? An equity instrument. Why? Because shares, the entity has no obligation to repay. Then the entity buying the shares will recognize a financial asset being equity investment under its non-current assets. Being equity investment under its non-current assets. So issue of shares, no miracle. The company issuing the shares will recognize equity because we have no obligation to repay. The entity buying the shares will recognize a financial asset in the name of equity investment, which will be under their non-current assets. Scenario number 2. This is what we saw yesterday in the question that we solved. If you remember yesterday, the footnotes that we dealt with, this is it. I told you that it is in IFRS 9. This is it. Sale of goods with repurchase option. When we sell goods and we have an option to buy back the goods, then it is not actually a sale, but instead it is a financial arrangement. So because it is a financial arrangement, the company selling the goods would have to recognize financial liability. So if you remember yesterday, the question we were solving, we recognized what? A loan note to SPD because they sold the goods with an option to what? Buy it back. Then the entity buying that goods that have an option that the seller will come and buy it back, in their books, they will recognize financial assets. So this was the scenario we saw yesterday, and you saw how the treatment was done because it is not a sale, but it's a financial arrangement where the inventories are used as a collateral facility. So that was what we discussed yesterday when we were solving the question on Atlas and the first footnote, so sale of goods to SPD. Next one, issue of loan notes. When an entity issues loan notes, does the entity have an obligation to repay? Yes, by default, we expect the entity to have an obligation to repay. So the loan note will be recognized in the books of the entity issuing the loan note as a financial liability. So the entity issuing will recognize a financial liability. Then the entity buying the loan notes, the entity buying the loan notes will recognize financial assets. So what is happening here is that the entity buying, the entity purchasing will be recognizing financial assets throughout. But the entity issuing, selling, or raising the finance will be contemplating between whether to issue or recognize financial liability or equity instrument. Next one, issue of convertible loan notes. We're going to get into this in a moment and you're going to see it. When we issue a convertible loan note, IAS 32 financial instrument presentation states that we have to recognize it as a financial instrument that has two components. So we would have to recognize a financial liability and also an equity instrument. So in the books of the entity issuing the convertible loan notes, we have to recognize both a financial liability and an equity instrument. We're going to get into that in a moment. and you're going to see how it plays out. Again, the entity that is buying the convertible loan notes will still treat it as an investment, so they will recognize financial assets. They will recognize financial assets. Then the last one, which is under IFRS 16, that we'll be looking out for later on, that is sale and leaseback transactions, where the performance obligation is not satisfied. Again, when we get to IFRS 16 leases, we will talk about this there. So if you remember in my introduction to the class, I told you that IFRS 15, IFRS 9, and IFRS 16 are related. They have something in common. Even though they can be individual in their depth, in their environment, they are related. So you saw the IFRS 15 and IFRS 9 earlier, sale of goods with, repurchase option. You are seeing the same thing coming up here with IFRS 16, IFRS 15, and IFRS 9 in that particular case. So when we sell assets and we lease it back and the performance obligation is not satisfied, then we would have to recognize a financial liability. In our books, the company that is supposedly selling and leasing back the asset. Like I said, we'll explain this later on under IFRS 16. Then the last thing is that the entity buying the supposed asset, who becomes the quote-unquote the lessor, will be recognizing a financial asset, because we have not bought the asset, because risk and reward has not been transferred as per the requirement for IFRS 15. So these are some transactions and events that gives rise. And like I said, always, you must know whose books am I in. Am I in the books of the acquirer, the purchaser, the investor, or I'm in the book of the issuer, seller, or the one raising that finance? Depending on the book we are in and the treatment that must be done. Let's talk about financial liability. Like we mentioned, in the case of financial liability, the company in question is issuing. The company in question is the one raising the debt finance. The company in question is the one, who is selling generally. So how do we account for financial liabilities? How do we do that? Initial recognition. So according to IFRS 9, financial liability shall be recognized at fair value less transaction cost. Shall be recognized at fair value less transaction cost. So we're going to be bringing in the fair value, or if you want, the proceeds, very simply, then we will less transaction cost. Now, the transaction cost is the cost that we incur in arranging the contract. The cost we incurred in arranging the contract. And that becomes the initial measurement.